Welcome back to Investing Talk Podcast.
Today we're looking at Richtech Robotics.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. For you, the most important story here isn't really a single earnings number. It's more of a seismic strategic shift happening inside Richtech Robotics.
Right.
The company is fundamentally moving away from being, a traditional hardware vendor.
Selling a robot once and then just moving on.
Exactly. They're moving to embracing a service-oriented model.
So they're executing that classic pivot toward what the industry calls robotics as a service, or RAS.
That's it. This means they are aggressively transitioning their revenue base from those chunky one-time product sales.
Oh, long-term multi-year service agreements, the MSAs.
Yeah.
Creating that predictable annuity stream.
Precisely. And whenever a company makes a strategic shift this large, it shows up immediately on the income statement.
And usually not in a good way at first.
Not at all. We need to be clear. This pivot has a definite short-term cost. In the third quarter of 2025, we saw revenue decline by 18.4% year over year.
And that's the kind of number that causes immediate panic in the market. I mean, it sounds terrible.
It does.
If you just glanced at the headline, you'd assume demand is falling off a cliff.
Yeah.
But we have to look past that top-line number and analyze the underlying motivation. Why would management deliberately take an 18% revenue hit?
Because the payoff is exponential. This is the ultimate bullish pivot, and it is, entirely centered on margin expansion.
Okay.
By shifting to RAS, where they are providing ongoing maintenance, software updates, all that centralized management, they completely reset the unit economics of their business.
And the results are, well, they're staggering. The payoff is a dramatic, almost unheard of improvement in gross margins.
In Q3 2025, their gross margin hit 74.4%.
Wow. Just to give you some perspective, this is a 410 basis point improvement over the prior year. That number fundamentally changes the narrative around this company.
75% gross margin is the territory of pure software companies.
Right. Or maybe highly differentiated pharma products, not typically service robotics, which often carries significant maintenance and hardware depreciation costs.
And if we look at the entire 9-month period for 2025, it's even better. Margins reach 75.6%.
Let's just put that number into context for you. This is not a modest gain. This 75.6% margin is up from 62.0% in the prior year period.
It's a huge jump.
That 360 basis point expansion tells us that their new recurring service model is incredibly profitable and they possess real pricing power over their competitors.
I mean, think about that leverage. They are making substantially more money on fewer sales.
And that contrast is really the key here. Over that 9-month period, revenue was only down 3.1%, but gross profit expanded by 18.2%.
This indicates a very successful, very disciplined shift toward that premium, sticky, recurring revenue. The strategic gamble so far is paying off in margins.
It's impressive that they are locking in these margins, but let's be real. Restructuring a company from hardware sales to a RAS model, especially while securing massive national contracts that requires serious capital.
Oh, absolutely.
This is a massive strategic gamble. So how healthy is the balance sheet that's supporting this huge undertaking?
Surprisingly, despite that temporary revenue pressure we talked about, the company is in an exceptionally strong financial position.
Okay.
Their liquidity is robust, almost to an absurd degree. I mean, look at the current ratio. It's an incredible 120.2.
Wait, 120.2? That number is so extreme, it stops being just a financial metric and starts being a statement.
It really is.
Standard healthy companies aim for a current ratio of, what, 2.0? What does 120.2 actually mean in practice for them?
It means they are effectively sitting on a massive amount of ready cash and highly liquid assets compared to their short-term liabilities. They aren't just able to meet their short-term obligations, they could obliterate them without breaking a sweat.
So it gives management this massive cushion and immense financial flexibility to absorb the costs associated with this whole pivot.
They have Fort Knox liquidity.
And that liquidity is further cemented by minimal debt. Their leverage ratio sits right at 1.
Right. They aren't bogged down by heavy interest payments, which gives them immense latitude to fuel future growth initiatives, like deploying thousands of robots for a major new client, without that pressure of quarterly debt obligations.
They've also been very savvy about maintaining flexible access to capital. I saw they successfully raised over $3 million through common stock issuances earlier this year, back in June 2025.
Yes, but critically, they maintain two active application at the market, or ATM, offering agreements.
For you listening, an ATM offering means they can dribble out shares into the market quietly whenever the price is favorable, rather than being forced to execute a huge dilutive capital raise all at once.
Exactly.
But if they already have this massive cash cushion,
hmm
the one that results in the 120.2 current ratio, why keep those ATM agreements active?
It's all about optionality and opportunity. Having the ATM agreements in place means management can tap growth capital opportunistically. Say, if they land another national retailer and need immediate funding for inventory,
Or infrastructure expansion?
without having to dilute existing shareholders unnecessarily or wait for a specific financing window. It shows a disciplined, long-term approach to treasury management.
We also noticed a kind of hidden positive in their non-operating income that really speaks to how much cash they're holding.
The investment income.
Exactly. In the first 9 months of 2025, they recognized over $1.1 million in investment income. That's not from selling robots. It's the yield they are generating just by holding all those cash reserves in interest-bearing accounts.
Precisely. And when you factor in the sharply declined interest expense, they netted a positive swing of nearly $1.9 million in non-operating income year over year.
So they're getting paid to hold cash while simultaneously reducing their costs.
And funding their strategic pivot. It's really responsible balance sheet management.
So all this financial groundwork, it leads us to the biggest accelerant in this whole turnaround story, market validation. This is where the strategic vision meets real-world success.
Right. And the strongest recent catalyst here is the Master Services Agreement, the MSA, signed in August 2025 with what is described as one of the largest retailers in the United States.
This is truly a game changer, isn't it?
It is. This isn't some small regional deal or a proof of concept pilot. This is a commercial win with a top-tier national enterprise.
And it does a few things at once. It validates the technology.
It proves the viability of the RAS model at scale, and it provides a clear and substantial path for recurring revenue growth starting, very soon.
I think this partnership really confirms the entire investment thesis, this huge retail partnership, coupled with the move to that high-margin RAS subscription structure. It signals the market is finally recognizing the unique value of their proprietary system.
You mean the AI cloud platform, or ACP, and their super operator model?
Exactly. Explain that super operator concept.
The super operator concept is key because it frames them not as a robot manufacturer, but as an enterprise software and logistics provider. They are focused on centrally managing a vast, potentially thousand-strong fleet of deployed robots across hundreds or even thousands of enterprise sites.
So this major retailer deal is the first large-scale national stress test for that entire vision.
That's the one.
Okay. The bullish case is extremely strong. 75% gross margins, Fort Knox liquidity, and a definitive anchor client in national retail. But we cannot have an honest conversation without addressing the primary risk.
Which is immediate profitability.
Yes. The net loss for the 9-month period expanded significantly. It grew from roughly $5.1 million last year to over $12.1 million this year. That is a massive growth in losses.
It absolutely looks alarming on paper, and it should be the focus of any bearish critique. However, when you dive into the numbers, the vast majority of that expanded loss is attributable to one single line item.
General administrative expenses, G&A.
G&A expenses surged by roughly 269% year over year.
A 269% spike in G&A is, well, it's not a rounding error. It demands scrutiny. How certain is the analysis that this is a one-time cost tied to the pivot and not a symptom of underlying poor cost control that will plague future quarters?
And that is the essential question, the real execution risk.
So what's the answer?
The data suggests it is indeed front-loaded, one-time expenditure tied directly to scaling up to meet the needs of a major national client. This massive spike appears to be tied to compliance costs, legal expenses, infrastructure upgrades, or maybe organizational restructuring needed to handle enterprise-level deployment across the country.
What makes you so confident it's a temporary spike and not an endemic issue with management spending?
We look at where management didn't spend money. Critically, expenses for core growth drivers, R&D, and sales and marketing both actually declined year over year. Management showed spending discipline in those core areas while heavily front-loading G&A costs necessary for regulatory compliance and organizational scale. This looks like a calculated investment ahead of the revenue ramp.
So, if the G&A spike represents the necessary infrastructure cost to transition to a national RIAS provider, then the entire path to profitability hinges on two things.
Let me guess. 1, whether this G&A expense normalizes.
meaning it drops back down significantly. And two, whether that retailer contract successfully ramps up and delivers the expected recurring revenue stream.
Precisely. If that retailer contract doesn't materialize the way they expect, those front-loaded costs become extremely damaging.
But if G&A normalizes back toward prior levels, those 75% gross margins, even on the current revenue base, would instantly translate into a completely different operating profit picture.
It changes everything.
Okay, let's pivot to the competitive landscape. If robots are becoming ubiquitous, what sets Richtech Robotics apart? What is the competitive moat that will protect those 75% margins?
The moat here is built on two things: vertical specialization and technological lock-in. Their robots aren't generic multi-purpose tools. They are precision instruments tailored for specific service industry verticals: hospitality, retail, and healthcare. We're talking about highly specialized systems like IDAM, which acts as a bartender or barista.
Right, or DSTE for specialized industrial cleaning, Matridi for server assistance, that kind of thing.
Exactly. That focus on domain expertise makes the solution immediately more useful to a target customer.
But doesn't that vertical specialization limit their total addressable market? If they only focus on service industries, are they missing out on huge industrial or warehouse opportunities where their competitors operate?
That is the trade-off, yes. But they are prioritizing deep integration over broad application. Their strategy is that the deep vertical expertise makes the solution stickier and drives those high margins.
And the second part of the moat.
The real durable competitive advantage, the high switching cost, comes from the proprietary AI cloud platform, the ACP.
So explain that lock-in for the listener.
Think about what happens when a massive retailer integrates this system. They aren't just buying a handful of physical robots, they are integrating the ACP software platform into their entire workflow, training staff, connecting it to inventory systems.
And relying on its centralized management to run potentially thousands of units across thousands of locations. It's like integrating an enterprise resource planning software.
Exactly, like ripping out SAP or Oracle. Once a major enterprise like that national retailer integrates the robotic fleet and the management software into their core operational nervous system, the cost, the disruption, and the sheer headache of switching to a competitor becomes prohibitive.
You're locked in.
You're locked in, and that is a durable competitive advantage. This lock-in also creates a powerful data flywheel effect, where every deployed robot improves the centralized AI, making the next deployment better, further cementing their status as the operating system for enterprise automation.
That is compelling. Let's switch gears and talk about the technical outlook. What are the charts telling us, and what are the key near-term triggers investors should monitor to confirm this turnaround?
The technical structure remains bullish, which suggests investor confidence is holding firm despite that revenue contraction. The stock is trading constructively and well above its key long-term moving averages.
Which are?
Specifically, it's holding above the 50-day average, which is currently near $4.77, and the longer-term 200-day average, which sits near $3.09. That technical foundation supports the idea that institutions are accumulating shares quietly.
We've also seen analysts recognizing that the underlying fundamentals are changing faster than the headline numbers. One prominent firm recently raised their target price to $6, right?
They did, citing the successful strategic pivot toward ROS and the customer validation provided by that August MSA.
So looking ahead, what are the crucial catalysts?
There are two crucial near-term catalysts that will prove or disprove the success of this strategic shift. The most critical event is the Q4 2025 earnings report, expected sometime in December.
This is the moment of truth.
It is. Investors will be intensely focused on seeing the first verifiable revenue contribution from that August master services agreement with the major retailer. That report is the proof point for the entire high-margin raise pivot.
And the second trigger relates to whether institutional money is truly backing this play.
Correct. We need to watch the January 2026 institutional holdings disclosure window. When those 13F filings come out, they will reveal whether large funds have continued their quiet accumulation phase over the last quarter.
Their willingness to buy shares, even with those active ATM offerings potentially providing supply, would be a strong indicator of long-term conviction.
A very strong indicator.
So what does this all mean for you, the listener? In summary, Richtech Robotics is presenting a really compelling turnaround narrative defined by two key elements: dramatic gross margin expansion, which is sustained at 75%.
And major enterprise customer validation through that August retailer partnership. The challenge now is pure execution.
Right. Management has to successfully ramp up the retailer deployment, to justify those upfront costs. And critically, they have to demonstrate that the significant G&A expense spike was a temporary one-time investment in scaling up.
If they can control those costs and convert those 75% gross margins into normalized operating profits, meaning turning a profit consistently, this story could see a material change in trajectory over the next 2 quarters.
So the ultimate provocative thought for you to mull over as you watch this company. If the current revenue dip and the temporary loss expansion are simply the one-time, non-recurring cost of locking in 75% gross margin recurring contracts with the largest retailers in the country, is that short-term volatility worth the long-term, high-margin future?
If you found this analysis helpful and want to track how this execution risk plays out in the next few earnings cycles, please remember to subscribe to the Investing Talk podcast for more analysis of the companies moving the market.